Hi everyone. Here risk management frequently asked questions. You can see here the frequently asked questions which is very important for risk management people who are attempting the exam. Okay, so the first question is, without wasting our time, we will just have a glance of each and every questions. The first is notice money. So what is notice money? Okay, so there are four options given here. They are asking you notice money period is from how to how. Okay, from how till how much it will be. The notice money itself is very short term. Okay, very short term. That is the first option they have given is 1 day. Second is 2 days to 14 days. Third comes the 15 days to 1 year. And the fourth option is to more than 6 months. So friends, now remember here the answer is B. 2 days to 14 days. How you know? See, call money, it refers to when we are getting the funds. Okay, when we are getting the funds, that is call money refers to the borrowing or lending of funds for 1 day. So notice money, therefore, it refers to the borrowing and lending of funds for 2 to 14 days. And term money is the one who refers to borrowing and lending of funds for a period of more than 14 days. So you understood the concept. So here the question is notice money. So what is notice money? First option is 1 day. So 1 day will not come because it's for call money. If the question was for call money, you should say 1 day. The 1 day will be the answer. Here it's given notice money. Notice money means it refers to borrowing and lending of funds for 2 to 14 days. So the answer is 2 to 14 days. Next comes more than 14 days, that is term money. It will represent as term money. So rest all answer will be for term money. So our answer for notice money is B option, 2 days to 14 days. Okay. The next comes the risk management. Risk management means which risk the country risk classification is updated and published by ECGC on dash basis. They are published on which basis? Weekly, monthly, fortnightly and quarterly. So the answer for this is D, quarterly, because the specific organization, what will they do? The ECGC publishes the country risk classification on a quarterly basis. It will not publish on monthly, weekly or fortnightly. Instead, it will publish on quarterly basis. So without wasting our time, we should tick mark the answer for quarterly basis in your exam. So next comes from the exam point of view is the what does the grade A1 under short term rating indicate? I would repeat the question. Listen carefully. What does the grade A1 under short term rating indicate? The first option is moderate safety. It indicates moderate safety or minimum safety, then highest safety and very stable. So the answer for this is C, highest safety. The grade 1, that is the grade A1 under short term rating. Under short term rating, grade A1 indicate higher safety. Why? Because A1 instruments. So let's say what is A1 instruments first. A1 instruments with this rating are considered to have very strong degree of safety regarding timely payment of financial obligations. Listen carefully. A1 instruments with this rating are considered to have very strong degree of safety with regard to timely payment of financial obligations. So therefore, such instruments carry lowest credit risk. Okay, that is A1. A2 is also there. So see, you need to remember what is A1, A2, A3, A4, D and so on. Okay. A2, your basics should be clear. A2 means the instruments with this rating are considered to have strong degree of safety regarding timely payment of financial obligations. Therefore, it's considered it carries low credit risk. Okay. A3. What is A3 now? A3 is a moderate degree of safety regarding timely payment of financial obligations. Moderate degree of safety. Such instruments carry higher credit risk as compared to the instruments rated in two higher categories, that is A1 and A2. Next, A4 instrument comes. A4 rating is the instruments with this rating are considered to have minimal degree of safety. The safety will be less with regard to timely payment of financial obligations. So such instruments carry very high credit risk and are susceptible to default. Then comes the D category. So what D instruments with this rating are in default or expected to be in default on maturity? So what was the question? Grade A1 rating under short term rating, which means with safety. The answer will be C, highest safety. A1 we have seen they are very strong degree of safety regarding timely payment of financial obligations, and thus they carry lowest credit risk. The last question in this slide is accounts with total per party exposure of dash crores or with business turnover of not less than dash crores can be considered for external rating. I would repeat the question once again. See, accounts with total per party exposure of dash crores or with business turnover of not less than dash crores can be considered for external rating. So there are 4 options given. The first is the rupee 1, rupee 50. Second is rupees 5 and rupees 50. Third is rupees 10 and rupees 25. You can see in this slide. The D, the last option is rupees 8 and rupees 12. So you need to identify first. The answer is, I have already highlighted there. The answer is B, that is rupees 5 and rupees 50. Why? Because see here, anyone who is borrowing the money, okay, let's say anyone is there who is borrowing the money with any limit can get an external rating. Okay, can get an external rating. Which rating? External rating. The exposure limit of rupees 5 crore and turnover cutoff of rupees 50 crores comes into this picture only for the why it comes into this picture? To calculate risk. Only for the main objective is of them is to calculate the risk weighted assets, that is the RWA, risk weighted assets under Basel guidelines. So the borrowers falling under the answer option B, that is rupees 5 and 50, are classified as corporate and the applicable risk weight depends on their external rating. I would repeat once again, for the accounts here, the accounts with total per party exposure of 5 crores, okay, 5 crores or with business turnover of not less than 50 crores. That means it should be more than 50 crores can be considered for external rating. The answer will be B option, rupees 5 and rupees 50. So here in this video, in this slide we have seen the first, second and the third, fourth questions of frequently asked questions. Okay, so you need to read, revise and learn. In a next slide we are having like that more questions. Also in this video we will be covering more than 100 questions which will be helpful for you all to attend the exam. So the next question is, a bank holds a security. A bank holds a security that is rated AAA, that is rated AAA. The rating of the security migrates to A. Okay. So what is the risk that the bank may face? Is the question. So what is the risk that the bank may face? There are 4 options given: market risk, operational risk, market liquidation risk and credit risk. Okay. So see here, the answer for this is credit risk. Credit risk, the D option, credit risk. Why? Because a downgrading of rating is a sign of deterioration in the credit quality of the borrower and hence it's considered as a credit risk event. Please listen carefully. The question is, a bank holds a security that is rated AAA. The bank is holding a security that is rated AAA. Okay, AAA. The rating of the security migrates to A. What is the risk that the bank may face? It's a credit risk. Why? Because a downgrading of rating is a sign of deterioration in the credit quality of the borrower and hence it's considered as a credit risk event. So the next question is, banks initially follow dash for computing the operational risk capital requirements. So which method is the bank following? Which method is the bank following is there are 4 options given. you may be aware of. There are 4 options given. The first is basic indicator approach. Second is a standardized approach. Third comes the market research report, and the fourth is the modified duration. So the answer for this is a basic indicator approach. Basic indicator approach means it's a BIA. It stands for BIA. You know, as the name suggests, basic indicator approach, that is BIA is the basic, is the entry level for calculation of the operational risk capital requirements under Basel guidelines. See, BIA is the entry level, is as the name suggests, it's the basic, it's the entry level for the calculation of the operational risk capital requirements under Basel guidelines. The next question, moving back to the next question. Communication risk is a type of dash. So what is communication risk? Communication risk is a type of dash. The first is interest rate risk. Interest rate risk. Second comes market risk. Third comes the credit risk. Fourth is the operational risk. So the answer for this is last option, D, operational risk. Why? Because this is the risk of losses arising from inadequate or failed people, process or systems and external losses. I would repeat once again, operational risk is the answer. Communication risk is a type of operational risk. Why? Because this is the risk of losses which are arising from inadequate or failed people, process or its systems and external losses. When there is miscommunication between the bank staff and the customer, it would lead to the operational risk. When there is a miscommunication or the communication gap between the bank staff and the customer, it would lead to operational risk. Moving back to the next question, the risk arising owing to non-enforceability of contract against a counterparty is a dash risk. Which risk? It's a legal risk. Why? Because, see, I will repeat once again the question. The risk arising owing to non-enforceability of contract against a counterparty is the dash risk. Which risk? It's a legal risk. Why? Because the banks have a legal risk that an agreement entered into with the borrower may become unenforceable against the borrower. Legal risk is a part of operational risk. I would repeat once again. Why? Because why is it legal risk? Banks have a legal risk that has a agreement, or you can say an agreement entered into with the borrower may become enforceable against the borrower. Legal risk is a part of operational risk. So here too, in this slide we have seen 4 new questions. In our next slide, they will be having few more questions like this. You can be able to know the risk management important questions asked for exam. That is the frequently asked questions asked for the exam. So, next topic, next question is the what is the duration in market risk? Listen carefully. What is the duration in market risk? Okay, so there are given 4 options. They are given 4 options. Duration. So what is duration? Duration is a weighted average maturity of all the expected future cash flows of a security. The weights, that is the weights. The weights being the present value of respective cash flows. Second option is they have given it is a negative or liability sensitive gap. Third option is it is a positive or asset sensitive gap. Fourth is it is the period for which a security is held by the investor. So what is the answer here? What is the duration in market risk? Duration in market risk itself means the answer for this is A option. A option. Duration is weighted average maturity of all the expected future cash flows of a security, the weights being the present value of the respective cash flows. A answer will be there. I will give you an example for this. See, what is duration? Just now I have said you, duration is the weighted average maturity of all the expected future cash flows of a security, the weights being the present value of the respective cash flows. Let us take an example for you. Let's take an example of a 3-year bond which is 10,000. That like for an example, 3-year bond. Okay, 3-year bond for rupees 10,000, which that pays interest, let's say 100 rupees after 1 year, rupees 100 after 2 years, rupees 100 plus the principal. That is rupees 10,000 after 3 years. Okay, so the duration, how will we calculate the duration? See, the duration is calculated as below. You can see here R1. Okay, just remember what I am saying. I would publish this video to see R1. R1 is the rate of interest. R1, R2, R3. R1 is the present value of rupees 100 after 1 year. R2 is the present value of rupees 100 after 2 years. R3 is the present value of 10,100 after 3 years. Listen carefully. R3 is the present value of 10,100 after 3 years. Thus, the duration is equal to 1x R1 plus 2x R2, that is 2 into R2, okay, plus 3 into R3 divided by R1 plus R2 plus R3. You will get the answer. Okay, that's why the duration in market risk is, the duration is the weighted average maturity they will see of all the expected future cash flows of a security, the weights being the present value of the respective cash flows. Moving back to the next question, what is modified duration? What is modified duration now? Okay, modified duration. Okay, they have given you 4 options. The first is the modified duration, which stands for MD. It's a factor by which the value of the cash flow will vary due to the change in the interest rate. The cash flows value will vary, will differ due to the change in the interest rate. Second, it is the measure of price elasticity of debt instrument reflecting the percentage change in the economic value of the instrument for a given percentage change in interest rate. Third comes the both A and B. Fourth option is none of the above, that is none of the A and B. Okay, so what is the answer here? The answer will be C, both A and B. So what is modified duration? Modified duration means it's a factor by which the value of the cash flow will vary due to the change in the interest rate. Also, it's a measure of a price elasticity of debt instrument reflecting the percentage change in the economic value of the instrument for a given percentage change in interest rate. In this slide, we are having 2 questions published. In our next slide also, few more questions will be there. Moreover, you will be having 100 plus questions in this topic, that is risk management topic. So friends, here in this slide there are 4 questions. Just have a look in the slide. So what is PV01? Okay, PV means a present value. So what is present value 01? It's the basic points they are mentioning. So let's see here. See, what is PV01? They have given you 4 options. The first is it is a measure used to describe how a basic point change in yield affects the price of a bond. Yield means interest. The first option is it is a measure used to describe how a basis point change in yield affects the price of a bond. Second option is it's a measure used to describe how a basis point change in interest rates affect the price of a bond. Third is the both A as well as the B. Fourth option is none of the above. So what's the answer here? The answer is A option, that is PV01 is a measure used to describe how a basis point change in yield affects the price of a bond. That is, modified duration measures the impact of a change in interest rate, not yield, on the price of a bond. I would repeat once again. See, PV01 is a measure used to describe how a basis point change in yield affects the price of a bond. Okay. Then comes the modified duration also measures. The modified duration means it measures the impact of change in the interest rate, not yield, on the price of a bond. Thus, the answer is A option. Next question, moving back to the next question. Next is exchange rate risk forms dash. Exchange rate exchange rate risk forms part of. It is a, which part? Is it a credit risk? It's a part of credit risk, market risk, operational risk and liquidity risk. It's a which part? Exchange rate risk itself means market risk. It's a part of market risk. Why? Because see, what is market risk? Friends, what is market risk? Market risk is defined as the possibility of loss to a bank caused by the changes in the market variables like on and off balance sheet, the positions being adversely affected by the movements in equity and interest rate market, then the forex exchange rate and the various prices. Thus, the market risk is further categorized into interest rate risk, foreign exchange risk, commodity price risk, equity price risk. Okay, so the answer for this is, it's a part of, that is exchange rate risk forms part of market risk. Why? Because market risk is a risk which is defined as the possibility of loss to a bank which is caused by the changes in market variables. Which variables? The factors like on and off balance sheet. The on and off balance sheet, the movements in equity and interest rate markets, foreign exchange rates and so on. Thus, the market risk is therefore furtherly categorized into interest rate risk, foreign exchange risk, commodity price risk and equity price risk. Moving back to the next question. The next question is what is the risk weight allotted for unrated corporate accounts? Listen carefully. What is the risk weight allotted for unrated corporate bonds, that is the corporate accounts? There are 4 options: 50, 100, 75 and 80. Okay, in terms of percentage, 50, 100, 75 and 80. So the answer is here 100. Answer is 100. Why? Because unrated accounts of corporates as defined under the Basel guidelines is 100%. You may note that the corporate borrowers, okay, listen friends, you may note that the corporate who are there, the corporate borrowers who have been rated BB or below or less than BB, they attract risk weight of 150%. That is higher than those that were unrated. Thus, here the answer is B, that is 100% is been allotted for unrated corporate accounts. Next question is EAD. That is, EAD is nothing but exposure at default. Exposure at default. Okay. EAD under risk management refers to dash. EAD under risk management refers to dash. There are 4. First is exposure at default. Second is external audit date. Third is expected annual dividend. The fourth is earning at disposal. I have already given you now the answer. EAD indicates exposure at default. Is because what is exposure at default, friends? Exposure at default, EAD. It is the amount that is due from the customer at the time when the default occurs. So thus EAD can differ substantially from a current outstanding in the account. I will give you an example. For an example, let's say a cash credit is there. A cash credit account with low utilization today. Okay, a cash credit account with low utilization today might be drawn to full 100% at the time of default. So on the other hand, what will happen? The term loan outstanding as on date might have come down substantially by the time of default occurs in the account. Okay, and of course, if the borrower does not pay the term loan installments and the installments, then the interest dues, if the borrower does not pay, then the EAD, that is exposure at default, may be more higher than the current outstanding even for term loans. I hope you are getting the topic what I meant to say now for EAD, that is exposure at default.